back to Morning Trade Live. It's time to go inside out on Walt Disney. We've gotten the latest details. We're hearing more about ESPN growth. Seth Schachner's with us, Managing Director of Schwab Americas. Thank you so much for being with us. What are some of the standouts? And I'll ask specific questions, but what really took you?
Great to be here, Nicole. The big news, I think there's one really big piece of news, which is on the streaming front, which obviously gets so much attention, but it's all about, Disney's got a standalone ESPN app that it's going to roll out in a couple of weeks. I think it's $30 a month is what it's coming out. It's going to have a lot of content in there, MLB, NBA content, but the big news is, that really stood out is this kind of swap, if you will, between NFL with its NFL network and something called the Red Zone, and making that available inside this ESPN Sports app, basically. And I think the striking thing about it is that there's going to be an equity stake for the NFL in ESPN, and so there's a ton of stuff to talk about on both sides of it. But I see it as something pretty strategic for the league, because they're really going to kind of keep that relationship warm going forward for the future. There's a ton of competition for sports rights. Obviously, ESPN and legacy pay TV are, perhaps, on the decline, if you will. And I think it's a really smart way to kind of shore this relationship up, basically. And that's what really stood out for me. I'm kind of watching it to see if, other leagues like basketball and baseball are going to try and emulate it. And, I think one thing that some young people have made clear to me who really follow the app and use it, I think there'll be people looking on the product side of it to see, if ESPN does a good job with the NFL app. So that's probably the biggest thing. And, the other piece of the Disney story now is just is parks. It's always a huge contributor to what they do. Not always front and center in terms of the reporting, but it looks like it's strong. And Disney's got a lot of positive stuff. There's a new park in Abu Dhabi that's coming, that's financed locally. And I think that's a wonderful way to increase their footprint, basically. And, the domestic parks, I think, are doing well. They just kind of got to watch the pricing on that, how much pricing pressure they can actually put on consumers on it before people start to miss going there.
Right now, you talk about the stock here, it's at $113, and there's so many different revenue streams. You mentioned the theme parks, NFL, ESPN, all the different parts. The red zone part of it, huge. Anybody I know that watches football, likes football, fantasy football, live for red zone. So to have that available seems like a big deal. We didn't really get into WWE much. Thoughts there?
Yeah, look, clearly, I think there's so much competition for sports, not just with Disney, but, there's lots of other implementations around football for sure. I'll mention what's going on in Prime and NFL Sunday Ticket, which I'm a fan of as well with YouTube. But yeah, I think wrestling and other sports that are out there, certainly women's sports, are things that for sure they're going to be popular, if you will. And, the app's going to want to have it in there, basically.
Right. And so when we think about Disney right now, and the parks and the movies, what do you think keeps driving Disney for the next 10 years? That keeps Disney as a lead player. They missed on revenue. They raised the full year EPS outlook. What keeps Disney alive here?
Look, Bob Iger, and to be fair, even predecessors before him, in my view, have done like the world-class job, if you will, of setting that company up with multiple engines, not just with sports and every piece of it, but with content alliances, Pixar, Marvel, obviously the Fox acquisition. These are things that bring in tons of different types of content. I'll zip into TV for a second. They also announced they're going to pull Hulu into the Disney Plus app. Hulu is the thing that's got, shows like The Bear on it that brings prestige content in, shows from all over the globe into it. And, this is how to do it right now in the modern age if you're a major entertainment conglomerate. So he, I think, and the board and a solid slate of leaders there, and there's definitely some questions about his succession down the road, but they've done just a wonderful world-class job of setting this thing up to compete with other studios and then with all the tech titans that are out there. It's about diversity and a diverse range of assets that they brought in, for sure.
So I'm just looking for some price targets here. Right now, the stock's at $113. The high was $124. I'm sure a lot of the analysts think it can go back to the highs. Do you think that it can get back to that? I mean, that's only about $10 from where we are right now.
Yeah, I do. I think the street tends to sometimes focus on certain aspects. I even saw today there's kind of a renewed focus here on subscriber growth on the Disney Plus app as opposed to profitability. But this is a company that's always done a fantastic job of managing its business, its costs, its spending, and also its growth. And so, yeah, I mean, I'm a big proponent of Disney all around. So sure, why not? Especially when you look at things out there like Netflix and just the enormous prices of some of their competitors that are out there in the streaming and tech landscape.
Quickly, Disney Plus, how are we feeling about that today?
Good. I mean, the big news there is that they're going to incorporate Hulu, which has been kind of this weird thing that stands alone. They're still going to offer it as a standalone. But I think it's Netflix and Disney Plus, and then all the others are kind of also rans on it. I don't see that changing anytime soon. And I bet if you're in the other landscape, if you're a Max or a Peacock, you're probably going to be looking at ways to combine.
Yeah, I mean, they really have so much focusing on content. They are raising the profit. Look, Seth Schachner, thank you. Strat Americas, really appreciate it. Now we take a look at the stock because Tom White, host of Fast Market, is with us. And you're looking at an example trade here. This one is bullish. I think you have a couple. The bullish trade first, please.
Yeah, Nicole, even though the stock's down, trading about $114 right now, implied volatility level has been crushed post the event risk here. So I looked at a strategy that's maybe a little bit more aggressive, probably sets up with Seth's analysis here if you think it's going to rebound, but giving yourself some duration. So using the option market here, I went out to the October monthly cycle, so 72 days to expiration, right? You got to go over 2 months in this trade for the stock to kind of rebound towards those $125 levels. I looked at buying a bullish call vertical. I'm going to buy the in the money 110 strike call, and then against it to offset some of the risks on that bullish call purchase, we're going to sell the 125 strike call. So a bullish $15 wide call vertical to the upside. You're going to pay roughly about a $5.80 debit. Maybe it's trading around $6 now, but the debit you pay is going to be your risk, right? So if you pay $5.80, you got $580 at risk, but you can make over $900 on this trade if it goes back above 125 over the next 2.5 months here or so. The break even on this one to get above that 105.80, that's only about 2% higher than the current share price in there. So you don't need a big, massive move to the upside. And because you're buying this directional vertical, you have some flexibility as far as trade management goes, right? Hey, I don't have to wait until expiration in 72 days to get out of this, the entire trade or a portion of it. Because if I do get that movement higher where this thing starts to expand in price, it gives me that flexibility to maybe close a portion of it or all of it prior to expiration. So this might be the way to look at it, because buying verticals in a low implied volatility environment means it's going to cost you less. You're going to have less at risk.
All right. Thank you for that. So at least you have some bulls out there who want to check it out and watch it go higher. How about the neutral example trade for Disney today, Tom, please?
Yeah, it's a little less aggressive, but you've got to be willing to own the shares if the stock does continue to move to the downside. So I went out to the August 29th weekly cycle, so about 23 days to expiration, about 3.5 weeks here, where I'm just going to sell a slightly out of the money put, cash secured put here, with the thought that, hey, if the stock continues to move higher or at least consolidates above the 112 strike, then I just get to keep the credit that I collected. So August 29th weekly options here, sell the 112 strike put. You're going to collect roughly about a 220 credit, might be a little bit lower than that now. But the credit you collect is what you can make on this trade. But it's twofold on this type of position. If the stock continues to fall, goes below 112, into expiration over the next 3.5 weeks, then you'd have to buy the shares. But because you collected a 220 credit, it takes your break even down to 109.80 to the downside. That's nearly 3% below the current share price. So you've got to think of it in that context, that you either want to keep the credit you collected, or if you think it's going to go lower, hey, I can buy the shares at a discount to where they're currently trading. And if I don't have to buy them, if it doesn't go below 112, I just get to keep the credit I collected.
Tom White, thank you for the example trades every single day here, each morning, showing us some ideas. Appreciate that.